Welcome to the deep dive. Okay, so we've got this really interesting situation right now, September 2025. Bitcoin, it's kind of sluggish, isn't it? Trading around $112,000, maybe $115,000.
Yeah, hovering. Stuck, almost.
Exactly. But then you look at the predictions coming out from pretty much everyone for the end of this year, end of 2025, and they're talking huge numbers, way past $200,000 sometimes.
It's a fascinating contrast.
No,
It really
yeah.
is. You've got this classic tug-of-war going on. On one side, massive long-term structural demand, the institutional money, the halving
The
effect,
big picture stuff.
the big picture stuff, exactly. But right now, that's being kind of overshadowed by short-term jitters.
Mm-hmm.
Market anxiety, a lot of technical deleveraging we've seen recently.
So our mission today, let's dive into the source material. We need to figure out two things. First, why is Bitcoin struggling right now? What happened in September?
And second, what are these expert predictions actually saying? Get into the specifics, the range, because it seems pretty wide.
Mm-hmm.
What's driving that huge optimism for the next, 15 months or so?
Okay, let's start with the current pain. The September market. Bitcoin hit over $124,000 back in August. Looked pretty strong.
It did.
Then, bang, a sharp drop. Lost that 115K support, which felt pretty key psychologically. Now it's just sort of consolidating below that near $112,800 or so.
And it wasn't just a little profit taking, was it? The sources we looked at point to like 4 specific things hitting all at once. A perfect storm, really.
Right. So factor one.
The macro picture. It just got colder, basically. The Federal Reserve started sounding more cautious about cutting interest rates further.
Ah, the Fed speak.
Exactly. And when the Fed signals, hey, maybe money stays tighter for longer, what happens? U.S. bond yields go up.
Making bonds look safer, more attractive.
Precisely. So capital, especially big institutional money, starts flowing away from things perceived as riskier. And crypto is, well, it's often high on that risk list. It's a fundamental money flow thing driven by the central bank.
Okay, that explains the general mood turning sour. But the speed of the drop felt pretty dramatic, like something broke internally in the crypto market itself.
You're absolutely right. That cautious macro tone basically lit a fuse under a highly leveraged market. That's factor two, a massive liquidation wave.
How massive are we talking?
One of the biggest in a while. Across all crypto, over $1.7 billion in leveraged long positions got wiped out, just flushed.
$1.7 billion. Wow.
And here's the critical part for Bitcoin. $1.5 billion of that was BTC longs alone.
Wait, $1.5 billion just in Bitcoin? If this market is supposed to be maturing, getting institutionalized, why are we still seeing these huge leverage blowups? Is that normal?
It's becoming more normal, perhaps, with the scale of derivatives now, but it's amplified.
Yeah.
The price ran up so fast in August, traders got heavily positioned, likely with high leverage.
Both retail and institutional trader.
Yeah, institutions use leverage too, especially in futures. So when that first macro shock hit, it just started a chain reaction. Margin calls, forced selling.
Yeah.
It shows that even with institutional money coming in, the derivative side is still super volatile and sensitive.
Got it. So macro shift, then a leverage cascade. What were the other two factors that piled on? Something about derivatives and the calendar.
Exactly. Third factor, options expiration. We had a huge volume of Bitcoin options contracts expiring, over $17.5 billion worth.
$17.5 billion. That's enormous.
It is. And when that happens, it adds significant selling pressure as people unwind hedges or settle positions. Combine that structural derivative weight with the liquidation cascade, well, it just fueled the downturn.
Makes sense. And the final piece.
Just plain old history. September is often a rough month for Bitcoin. Looking back over the last 12 years, it averages, a 3.77% decline?
So not just random noise, it's a pattern.
It's a pattern. So you've got this mix. Macro worries, leverage getting flushed, huge options expiry, and seasonal weakness. It really does explain why we dipped down near 112K.
Okay, that paints a clear picture of the September slump. But here's the paradox we started with. Despite all this short-term pain, the sources, they're still incredibly bullish long-term.
Completely. The underlying drivers fueling that optimism, they haven't really gone away. In fact, some seem to be getting stronger.
Right. It's easy to get bogged down in the September red, but the narrative for 2025 looks totally different, according to these experts. Let's pivot to that optimism. Two big themes seem to drive it. Politics and regulation and just sheer institutional weight.
Let's start with the political side, because that's seen a major shift, apparently, since the U.S. election back in November 2024. The outcome seems to have created a much more, let's say, crypto-friendly sentiment overall.
And the expectation is for key appointments that could really change the regulatory environment.
That's word on the street, yes. The big one everyone's watching is the potential appointment of Paul Atkins to chair the SEC.
Right. Atkins is seen as much more industry-friendly than the previous chair. That alone would be a huge relief signal for the market, wouldn't it? Suggesting maybe less regulation by enforcement.
Absolutely, a shift towards clarity. And beyond personnel, there's talk of a major policy change, getting rid of the SEC's Staff Accounting Bulletin 121, SAB 121.
SAB 121.
Ugh.
Remind us why that was such a big deal.
It was a huge roadblock for banks. It basically said if a U.S. bank holds crypto assets for a customer, they have to record those assets as a liability on their own balance sheet.
Which sounds bad for a bank's capital requirements.
Terrible. It made holding significant customer crypto almost impossible from a balance sheet perspective. So it effectively discouraged almost every major U.S. bank from getting into large-scale crypto custody.
So removing SAB 121 doesn't just please the banks.
It potentially unlocks a massive amount of traditional custody infrastructure and capital that's been sitting on the sidelines. It's huge.
Okay. And there's more on the political front. Mining support, even a strategic reserve.
Yeah, the sources mentioned plans to promote crypto mining in the U.S., maybe even establish a strategic Bitcoin reserve, things that would give Bitcoin a level of political legitimacy it just hasn't had before.
And globally, investors see this regulatory clarity as the #1 catalyst.
Overwhelmingly, 57% of institutional investors surveyed pointed to regulatory clarity as the single biggest driver for growth. It's what they're waiting for.
Makes sense. So you have that regulatory tailwind potentially combining with the supply and demand picture. The halving already happened in April 2024, cutting new supply.
Right. The daily issuance got cut in half.
And on the demand side, it's all about the institutions now, isn't it? Via those spot Bitcoin ETFs approved back in January 24.
Absolutely pivotal. Those ETFs have been game changers. Just look at BlackRock's IBIT fund. It pulled in over $57 billion in assets under management.
$57 billion in one fund. That just fundamentally rewires how Bitcoin is priced, moving it from mostly retail to heavily institutional.
Totally. And the appetite is still there. Surveys show 85% of institutional investors increased their crypto holdings in 2024. And looking ahead to 2025, 59% plan to allocate over 5% of their total assets under management to digital assets.
Wow, over 5% AUM. That's not trivial side bets. That's serious balance sheet commitment.
Serious commitment. So when you see that kind of institutional muscle flexing, well, it's no surprise the price targets get pretty wild.
Okay, let's get into those numbers. The predictions. It seems like there's a huge range, so maybe we can group them, understand the different thinking behind them.
Yeah, the range is definitely wide, which reflects the volatility.
Yeah.
But the general direction is clearly up. We can probably group them into, say, 3 camps.
Yeah.
Let's start at the top. The really, really bullish calls, often based on technical models.
The hyper bulls. Who's leading that pack?
The highest specific target we saw comes from a Bitcoin researcher, Sminston with. They're targeting $275,000.
$275,000.
Specifically, November 1st, 2025. It's based on some complex quantile regression modeling looking at historical adoption curves versus supply shocks.
Yeah.
Basically, the model sees adoption accelerating way faster than supply.
Very specific, very bullish. Okay, who else is in that upper echelon? Maybe more focused on the institutional flows.
All right, let's call that the institution consensus camp. Here you've got well-known names like Tom Lee from Fundstrat and the venture capitalist Tim Draper. Both are projecting $250,000.
And their reasoning.
They explicitly cite that combination we discussed. The regulatory shift making things easier, plus the sustained institutional buying pressure through the ETFs.
Okay, and slightly below them.
You have a cluster around $200,000. Standard Chartered Bank is looking at that by the end of 2025. Alliance Bernstein thinks maybe even sooner, by September 2025. Bitwise Asset Management is also in that $200K bracket.
So a strong institutional consensus forming between, say, 180K and 250K, driven by policy and ETF flows. But it can't all be moonshots, right? What about the more cautious voices or even bearish views?
You definitely need that balance. Let's call this camp the cautionary bears and volatility warnings. At the upper end of caution, you have Matthew Siegel from Vinek and Alex Thorne from Galaxy Digital. They're forecasting maybe $180,000 to $185,000. Still very high, but suggesting the path might be slower, bumpier.
Okay, still bullish but tempered. What about actual bears?
Investing Haven lays out a bearish scenario where Bitcoin struggles and maybe hits $75,000. And the technical analyst Peter L. Brandt, he warned that certain chart patterns could potentially indicate a drop down to $78,000. So downside risk is still flagged.
And then there's one prediction that just perfectly seems to capture the sheer whiplash volatility of Bitcoin.
You mean Robert Kiyosaki? Yeah, that's a wild one. He predicts a sharp drop first, down to maybe $60,000 sometime in 2025.
Oh.
Followed immediately by a massive surge later that same year, up to $250,000.
Wow. A round trip like that. It's a roller coaster forecast, but maybe realistic in terms of the potential swings along the way.
It certainly reminds you that even if the target is $200K plus, the journey there is unlikely to be a straight lineup. Volatility is the name of the game.
So taking all that in, the sources seem to suggest that maybe a target like $150,000 is seen as, challenging but doable if certain things fall into place.
That's a good summary of the midpoint view. Challenging but achievable is a good way to put it, but it relies on specific conditions being met. The sources mention three key ones.
Okay, what are they?
First, the macro headwind needs to flip. We need the U.S. Fed to actually cut interest rates, maybe around September 2025. That would ease the pressure on risk assets.
Makes sense.
Second,
A second wave of corporate treasury allocations. We need more big companies, beyond the early adopters, to start putting Bitcoin on their balance sheets.
Okay, broader corporate adoption. And the third one sounded a bit technical, something about MiCA and stablecoins.
Yeah, this one's important for tapping into global liquidity. The third condition is needing MiCA-licensed stablecoin issuers to start seeding EUR BTC liquidity pools.
Okay, break that down. What's MiCA and why does Euro liquidity matter so much?
So MiCA is the big new crypto regulation framework in the European Union. Getting stablecoins licensed under MiCA basically gives them a regulatory stamp of approval in Europe.
Legitimizes them for institutional use.
Exactly. It lets large European institutions, who were maybe hesitant before due to regulatory uncertainty, confidently use regulated stablecoins to trade in and out of Bitcoin using euros. It opens up a huge pool of European capital.
So it's about globalizing that institutional on-ramp, not just relying on US dollars and US ETFs.
Precisely. It connects the European institutional market seamlessly.
That really shifts the focus, doesn't it? It's not just about holding Bitcoin as digital gold anymore. It's about integrating it into the actual plumbing of global finance.
Right. And if we look beyond just the price predictions and see how institutions are actually using this stuff, it moves from speculation towards real utility.
So how are these big players getting their exposure? Still mostly through those ETFs.
Overwhelmingly, yes. For initial exposure, 60% prefer registered vehicles like ETPs, exchange-traded products. They offer that regulatory wrapper, the familiarity.
Which explains the demand for more products beyond just Bitcoin and Ether.
Absolutely. That's why you're seeing growing interest in diversified crypto index ETPs and even new single-asset ETPs for other tokens like, say, Solana or XRP. Institutions want regulated access to the broader ecosystem.
And this ties into that whole tokenization trend we keep hearing about, using blockchain for real-world assets.
It feeds right into it. Tokenization is arguably the biggest long-term structural shift being discussed in these sources. 57% of the institutions surveyed said they're interested in investing in tokenized assets.
And why? What's the main driver for them? Is it chasing yield?
Interestingly, no. The primary driver, cited by 65%, isn't yield, it's portfolio diversification. They want to take traditionally illiquid assets, think private equity funds, real estate commodities, and make them more easily tradable on a blockchain.
So unlocking liquidity in existing asset classes, what specific assets are they most interested in tokenizing first?
The top two mentioned are alternative funds, like private equity or hedge funds. 47% are interested in those, and commodities, cited by 44%.
And this isn't some far-off dream. They're planning to act soon.
Seems like it. 72% of the institutions interested said they plan to actually invest in tokenized assets by the end of 2026. So within the next year or so. That shows real conviction in the utility of the tech, way beyond just Bitcoin's price.
And one final piece of that institutional shift, decentralized finance, DeFi. The numbers there look pretty dramatic.
They really do. The projection is that the percentage of institutional investors actually engaging with DeFi protocols could nearly triple in the next 2 years, jumping from around 24% today to potentially 75%.
Wow, 3/4 of institutions potentially using DeFi. What would they be doing there? This isn't just buying tokens, right?
No, this is about actually using the protocols. Things like earning yield on stablecoins, using assets as collateral for loans in a more transparent way, accessing on-chain lending markets. It signals a move towards actively using the decentralized infrastructure to manage capital more efficiently.
Okay, this has been a really comprehensive deep dive. We've gone from the gloom of the September price action all the way to these really high-flying targets for 2025 and beyond.
Yeah, we've definitely covered a lot of ground.
So to recap, Bitcoin's path right now, definitely rocky. We've got macro pressure, those big liquidations creating headwinds.
For sure. The short term is messy.
But the underlying structural forces, the political and regulatory shifts, the massive institutional demand via ETFs and future tokenization, they seem to be keeping those expert targets firmly clustered in that $180,000 to $250,000 range for late 2025.
That's the core tension, exactly. While the overwhelming consensus among experts points significantly higher long term, this sharp September dip is a stark reminder, isn't it? This is still a high-risk, high-reward asset. That volatility isn't just going to disappear.
You really have to zoom out.
You do. Investors need to look past the daily or weekly noise and focus on those deeper shifts, the regulatory framework solidifying, the institutional plumbing being built. That seems to be the real story here.
So let's leave you, our listener, with a final thought to mull over. We talked a lot about Bitcoin becoming digital gold and how institutions are pouring in, partly for diversification via tokenization. Here's the question. If diversification and accessing tokenized real-world assets become the main institutional drivers, does Bitcoin's future stability ultimately depend less on its own store of value narrative and more on its role as the foundational, secure gateway to that broader tokenized financial system? Something to think about.